Let's go straight to our conversation because time is already fast spent. A renowned economist and managing director of financial derivatives, Mr. Bismarck Rewane, says Nigeria could enter 2026 on its strongest economic footing in more than a decade. The boom, according to Mr. Rewane, will be anchored on a combination of easing inflation, rising investment, major corporate listings, and stabilizing monetary conditions, which is expected to propel the country into a new and more durable circle of growth. The economist, in a presentation held in Lagos, describes 2026 as a defining year in which structural reforms, private sector expansion, and improved policy coordination converge to reposition Africa's largest economy for a significant turnaround. Mr. Rewane's analysis points to a pivotal shift driven by reorganization of key sectors, manufacturing, banking, technology, telecoms, creative industry, real estate, under more favorable macroeconomic conditions. My guest is no other person than Mr. Bismarck Rewane, Chief Executive Officer, Financial Derivatives Company of Nigeria. Thank you so much for your patience, Mr. Rewane. It's good to have you join the program.
Good afternoon. Thanks for having me.
Yes, I think we should go straight to your submission. Heading for the biggest economic boom in a decade. What are the fundamentals, or what do you think would drive us to this point of productivity, according to your presentation?
Let me clarify a few issues. One is that I talked about a capital market boom. Capital market boom, which means that you would have the stock market capitalization will go from, at that time it was 93 trillion, and I was projecting that by the end of 2026, it will be at about 230 trillion, based on three things. One, the listing of the Dangote refinery, which has the capacity of putting in another 100 trillion or so on the market, the listing of NNPC, and then solid corporate earnings. So that, because of that capital market boom, it will have a knock-on effect on other things in the economy, right? Many have interpreted it to mean that an economic boom is different from a capital market boom, although two can take place at the same time. So having said that, that was in November. We are now in January, and second week of January. The world is a different place at this point in time. At that time, the price of gold was heading towards 5,000, and now it's kind of stabilized. At that time, the price of oil was 64, 65. Today, it's at 60 or 59. That's Brent. At that time, Venezuela was a growing entity, and today it's a different ballgame. And I did end my presentation, one of the presentations, and say, in the world of 2026, what you see is what you get, and what you don't see is what gets you. Therefore, I would like to talk about what's likely to happen in the next 2 to 3 weeks. We put out our projection on inflation, and our projections, based on our regression, is that there will be a temporary spike in inflation due to the rebasing effect. Because we did the rebasing in December 2024, and therefore, if you take December 2025, the effect, what happened in 2024 was it brought down the year-on-year inflation. What will happen now is that it will take up the year-on-year inflation, but nobody should be scared about that. It's a temporary phenomenon. It begins to level out after a while. So I think we bear that in mind, and nobody should panic because inflation spiked in 1 month. It's just part of the rebasing and change of methodology and constitution of the basket. But having said that, let us look at what's happening to commodity prices. At this time last year, we were talking about a bag of rice had just come down from 110 to around 95 in January, what we call the January effect, the post-Christmas blues. Now we are seeing that at 62,000 naira. 62,000 naira is low compared to last year. But if you compare it to 4 or 5 years ago, it's still a bit high. But generally speaking, we've seen a couple of things that are very clear to us. Another item we've seen is that the price of cocoa, which had dropped to about 5,000, is back up to about $6,000 a ton. We've seen earnings, and we've seen the stock market rally. We think that the stock market rally now is going ahead of itself, and that there could be an asset bubble in the creation, in the making. So we think that sizzle will fizzle short while, so there'll be an inevitable correction. But underlying the fundamentals of the main sectors of the economy remain strong. And why do I say that? If you look at almost all the companies that were declaring losses in 2024 and 2023 because of exchange rate losses are now beginning to run profits. But they have to recover all the erosion of capital which happened due to the losses, and before you start seeing massive dividends and massive price appreciation. So yes, the stock market is showing companies are earning much better than they earned 2 years ago. We see inflation will moderate, even in spite of the spike that you see for December and January. It will come down to the low teens, around 12, 13% as we go towards the middle of the year. The big risk we face is a drop in the price of oil. But having said that, we think that Brent will hang in at about 60 or 59, maybe $58 a barrel. That is dangerous for us, but to the extent that we have some buffers, means that it's not going to be catastrophic. It's going to mean that the economy will be able to withstand some of those shocks. But we shouldn't be carried away because of historical trends. We should look at the future, and the future says that there are some challenges because the variables that are within our control are definitely less than the things that are out of our control. So we are a very low-level producer in OPEC. Our quota is there. We have limited control over the vandalism in the Niger Delta. We have limited control over the logistics of food and the breadbasket of Nigeria.
Yeah. We
have some good signs that the Dangote refinery is functioning properly, optimally, and the price of petroleum products at $7.39, using today's value at the parallel market, it is about 45 cents compared to in South Africa, where it is $1.26. So we are actually paying 30% of the price of our neighbors for PMS at this time. So generally speaking, it's not a bad picture, but we should brace up for exogenous shocks, which are totally out of our control.
Now, you talked about investor sentiments already softening due to FX stability and some other factors. You've also touched on the geopolitical issues, which we know will shaping up the price of crude and all of that going forward. But how do you see that issue now with the crude oil price? Look at our budget projections and all of that. What's your reaction to the assumptions of our spending plan for 2026, considering the present state of the price of crude oil?
Two things. One, the price of crude is going to go down. Maybe worst case scenario goes down to about 55.
Okay.
What is the impact of that? Every dollar reduction in the price of crude increases our fiscal deficit, right? And it's how you fund the deficit. If you fund it from domestic borrowing, right, at the same time when you are bringing down interest rates domestically, then you would have money supply saturation. So we've got to watch that. But secondly, because interest rates are going to come down in February, I think, or so, February or March, Jerome Powell will be parting ways as the chairman of the Federal Reserve. We are going to have the sentiment in the US and the sentiment in parts of Europe is that we will see lower interest rates. That means that Nigeria and other countries that are going to be borrowing in the Eurobond market are going to be paying lower interest rates. But having said that, the debt service burden is debt service burden. Any amount of money you spend on debt service is not available for giving the people the funding infrastructure and funding government expenditure on health, education, and infrastructure. So you can't have it both ways. But the reality is that I asked one very simple question. One, if you have not prepared yourself with some buffers, right, the shocks will have been much more. But even then, when the price of oil was $65, $66 a barrel, the average of last year was even much higher. And now that we are seeing ourselves going into a 60 and sub-60 environment, what does that mean for us? It means that we'll have less money to spend. We would have to borrow money, both domestically and internationally. and we would have to be much more efficient in the way we spend. Not only that, we have to. It is imperative that we become much more transparent in the way we spend our money. So, and the difference between revenue goals and growth goals become very clear. You have to grow, and you have to grow, your GDP has to grow, but also your revenues have to grow to fund it. How are you applying this money, right? And how efficient is it? Are there leakages? Are there inefficiencies? Are there structural deficiencies in the economy? Yeah, you bet there are. But what's the plan to correct this? And that is where the real issue is. Nigeria will have to. And when I say Nigeria, I'm talking about Nigeria as a government, as a policymaker, as an investor, as an entrepreneur. The total entity of $250 billion or $255 billion of GDP will have to grow more than 4% as projected. To grow more than 4%, you need to do a lot of things. You have to encourage investments, you have to maintain stability, and you have to actually, whether you like it or not, keep interest rates high so that you will reduce the amount of capital flight that is going to happen. There are some tough days ahead. And also, there has to be transparency in the whole process of government spending and recycling of the funds into the markets. That is where we are. Yes, in November, October last year, the picture looked good, but nobody knew what was going to happen in Venezuela. Nobody knew what was going to happen in Gaza. Nobody knew what will happen in Ukraine. Nobody knows, and in fact, nobody knows now. But what we do know is that the price of oil is coming down. What we do know is that interest rates in the U.S. coming down. What we do know is that the price of gold is increasing as a haven, a value of safe haven. And what we do know is that Nigeria as a country, both in the private and public sector, has to work harder and has to deploy resources more efficiently.
Finally, before I let you go now, in straight terms, we are looking out for December 2025 inflation figures. That will be out sometime next week, I guess, and also
yes,
other economic indicators. What are your projections at the FDC, and you touched on it earlier, but specifically, what figures do you think would you have coming up for that next week for inflation and other indicators?
The projection is a forecast, right? And quite frankly, we think that it could go based on the regression, and we shouldn't place too much emphasis on that. It could go into the 20s or 30s, right? But it's a 1 month phenomenon, just reflecting the base year and the new competition with CPI. After that, it settles down. So when you take the running average, you'll still be at 15%. But that is where it ends. But now you begin to ask yourself, what are the factors that will keep inflation low? One is exchange rate stability, and right now we're seeing that the official rate is appreciating while the parallel market is depreciating. The central bank will have to reverse course and allow the naira to find its fair value, which is where it is about 1450, 1500. At that point, there'll be no window for arbitrage. Secondly, the price of petrol has come down, but compared to other countries and all of that, because the price of crude has come down, we would see probably a reduction in that price of petrol towards 700 naira a liter. Thirdly, money supply growth had gone up to 12. We think that the central bank will compress this a little bit. And in the February meeting, next month meeting, the central bank is more likely than not, to, depending on what happens in the Federal Reserve, to allow interest rates come down marginally, maybe by about 25 or 50 basis points. But that's all. But generally speaking, we think that inflation, even though it's a December inflation, is a one-off or 2 month spike before it comes down. And that is just in terms of methodology. And the reality is that the general level of prices is actually declining. Not as fast as we may want to see, but we are seeing that that will happen. So generally speaking, and the stock market rally, I told you that stock market rally is going ahead of itself. So there will be a correction in the next week or so. You will see some correction. And then you begin to see all investors will be on a wait and see mood that, okay, we don't know whether you like it or not. There's always an uncertainty to do with election spending and election outcomes. So investors, both domestic and international, will hold their breath and say, okay, let us see and be clear as to what the direction of the political direction is, and then they begin to invest. But if you discount the political uncertainty, which is only about, say, 12 months, and go forward, then you begin to see a tendency for things to improve, depending on not just policy reform, but institutional reform and a level of transparency and equity and fairness, so that the question of poverty, multidimensional poverty, perverse poverty, and insecurity are tackled. Or if you tackle that, then output of goods and services will increase, welfare will increase, and hopefully everything looks better. But there's a lot of work to be done. I don't want us to be carried away with the feeling that our work is done. Not.
Chief Executive Officer of Financial Derivatives Company Limited, Mr. Bismarck Rewane, I must thank you so much for joining the show today. Well, we'll follow up on all of these figures as we move on in the year. Have a great one. Thank you so much.
Thank you very much for having me.
All right.